the ultimate beginner's guide to pips, lots, and leverage in Forex trading. Hello family, welcome back to the channel. Today, we're breaking down 3 of the most fundamental concepts in Forex trading: pips, lots, and leverage. Getting a solid grip on these is absolutely essential before you even think about placing your first trade. So, grab a coffee, and let's dive right in. First up, let's talk about pips. You've probably heard this term thrown around a lot. A pip, which stands for percentage in point or price interest point, is the smallest price change a currency pair can make. Think of it like a single cent in a dollar. For most currency pairs, a pip is the 4th decimal place. For example, if the EUR-USD pair moves from 1.1050 to 1.1051, that's a 1 pip move. It's how we measure profit and loss in Forex. Now, for pairs involving the Japanese yen, like USD, JPY, a pip is the 2nd decimal place. So, a move from 110.40 to 110.41 is 1 pip. Simple, right? It's just the basic unit of measurement for price changes. Now, how do these tiny pip movements translate into actual money? That's where lots come in. A lot is simply a unit of currency that you're trading. It determines the size of your trade. The standard lot size is 100,000 units of the base currency. So, if you trade 1 standard lot of EUR-USD, that's where lots come in. A lot is simply a unit of currency that you're trading. It determines the size of your trade. The standard lot size is 100,000 units of the base currency. So, if you trade 1 standard lot of EUR-USD, you're controlling 100,000 euros. With a standard lot, each pip movement is worth about $10. That can add up fast. But don't worry, you don't have to trade that big. There are smaller sizes for beginners. A mini lot is 10,000 units, where each pip is worth about $1, and even smaller is the micro lot at 1,000 units, where each pip is worth about 10 cents. Starting with microlots is a great way to get your feet wet without risking too much capital. So, you might be thinking, how can I possibly trade 100,000 units when I don't have that kind of money? This is the magic and the danger of leverage. Leverage is essentially a loan provided by your broker. It allows you to control a large position with a small amount of your own money, which is called margin. For example, with a leverage of 100 to 1, you only need $1,000 of your own money to control a $100,000 position. This magnifies your potential profits. If your trade moves in your favor, you make a lot more than you would have without leverage. But here's the crucial part. Leverage is a double-edged sword. It magnifies your losses just as much as it magnifies your gains. A small price movement against you can wipe out your trading account very quickly if you're overly leveraged. This is the #1 reason why many beginners lose money. They get excited by the potential for huge profits and take on way too much risk. My advice, start with very low leverage, or even no leverage at all, while you're learning. Understand the risks completely before you even think about increasing it. Let's recap. A pip is the smallest unit of price movement. A lot is the size of your trade, which determines the value of each pip. And leverage is a tool that lets you control a large lot size with a small amount of capital, but it dramatically increases your risk. Mastering how these 3 concepts work together is the foundation of successful risk management in Forex. Always practice on a demo account first to see how they interact in real time without risking real money. Get comfortable with the mechanics before you go live. And that's our beginner's guide to pips, lots, and leverage. I hope this cleared things up for you. If you found this video helpful, please hit that like button, and don't forget to subscribe for more Forex trading content. Drop any questions you have in the comments below. Thanks for watching, and I'll see you in the next video.